Hi, professional. This is CA Rohan R. Pingali. Welcome to my YouTube channel, CA Rohan Pingali. And welcome to the video series under Direct Tax, What Law Says, Part 3. Let's start with our Part 3. Let me allow to share my screen with you. Yes. What law says direct tax part 3. Under this, we are going to discuss few of the case laws under reported to ITT and High Court. Let's begin. First case law. Ravinder Kumar versus ITA number 2265, Delhi ITT 2023, and relevant assessment year is 2011-12. Date of order 8th of November 2023, and relevant section is section 54B. Let's understand facts and issue of the case. Assessee sold agricultural land which gave rise to long-term capital gain. Assessee was sold agricultural land which gave rise to long-term capital gain. However, the assessee claimed that it had purchased another agricultural land and therefore entire long-term capital gain is exempt under section 54B of the Act. However, the AO denied the claim on the grounds that the land had been purchased in the name of the wife of the assessee. What AO denied that the claim on grounds that the land had been purchased in the name of the wife of the assessee. Aggrieved, the assessee preferred first appeal to CIT appeals, where CIT appeals held against the assessee, and then the assessee preferred second appeal to the tribunal. Tribunal observed and held that the tribunal noted the ratio of the decision of the tribunal in the case of Ashok Kumar versus ITO AY 910, order dated 20th December 2022, and the tribunal set aside the order of the revenue authorities and decided the issue in the favor of the assessee. That means tribunal allowed the assessee's appeal in the favor of assessee. Next. Rekha Singh versus ITO ITA number 2406, Mumbai 2023, assessment year 2015-16, and date of order is 30th October 2023. Relevant section is section 56 2, clause 7, subclause B. Let's understand facts and issue of the case. The assessee is an individual filed a return of income which was subjected to limited scrutiny. In course of assessment proceedings, the AO observed that the assessee has purchased an immovable property as a co-owner jointly with her husband. The consideration was paid by both co-owners. The AO was of the view that Section 56, subsection 2, clause 7, subclause D was to be applied. The assessee explained that as per proviso to section 56, subsection 2, clause 7, subclause B, the stamp duty value on the date of agreement may be taken for the purpose of this clause. The AO didn't agree with the submission of the assessee. Assessee preferred first appeal to CIT appeals, where CIT appeals confirmed the action of the AO and therefore aggrieved. The assessee preferred an appeal to the tribunal. Let's see what tribunal observed and held. Where the date of agreement for fixing the amount of consideration for purchase and the date of registration of sale deed were different, but assessee prior to the date of agreement had paid a part of consideration by check, Proviso to Section 56, subsection 2, clause 7, subclause B being fulfilled, the stamp duty value as on date of agreement should be applied for the purpose of said section. Since it was joint property owned by Assisi and her husband, it is immaterial who had made payment before the date of registration of the property, and therefore tribunal decided and appealed in favor of the Assisi. Next, Arun Manohar Pathak versus ACIT 2023 106 ITRT 14 Mumbai Tribunal ITA number 489 Mumbai 2023, and relevant assessment year is assessment year 1718, and date of order is 24th May 2023. Relevant section here is section 16(9)(a). Let's understand facts and issue of the case. The assessee was carrying on the milk distribution business. He deposited cash of certain amount in his bank account during the demonetization period in old currency notes, that is specified bank notes. The assessee submitted that he was a retailer of milk and the said cash deposits were out of the collection from the sale of milk to persons during the demonetization period, and the same had been used to make the payment towards purchase of milk to Gujarat Cooperative Milk Marketing Limited by way of demand drafts as reflected in the bank statement of the assessee. The AO treated cash deposit in the bank during the demonetization period as unexplained and added the same under section 69A of the IT Act 1961. Aggrieved, the assessee filed an appeal before the CIT appeals. However, the CIT appeals upheld the order of the AO. Aggrieved by the CIT appeals order, the assessee filed an appeal before the ITAT. Let's understand what tribunal observed and held that. Assessee had placed on record all the documents such as copy of the license, cash book, bank statement, ledger account of purchases made from Gujarat Cooperative Milk Marketing Limited. Assessee was able to substantiate the stand during the assessment proceedings, and the burden of proof was on the revenue. The ITAT further observed that CIT appeals had not dealt with the documents or details furnished by the assessee and failed to either carry out any inquiry or verification. The ITAT therefore held that AO as well as CIT appeals were incorrect in holding that the assessee was not covered by the notification, and the appeal filed by the assessee was allowed in favor of the assessee. Next, Amala Jyoti Vidya Kendra Trust versus ECIT ITA number 458 Bangalore 2023, and relevant assessment year is assessment year 2021-22. Date of order is 1st December 2023, and relevant section is section 12AB subsection 4. Let's understand facts and issue of the case. The assessee was registered white trust deed dated 1st April 2005. It was registered under the East 12 section 12AA, that is 12AA. Due to amended provision with effect from 1st April 2021, the assessee filed an application for re-registration under section 12A and 12AB, which was granted to it by DIT, that is Deputy Income Tax, from AY 22-23 to AY 26-27. On December 2021, a search was carried out under Section 132 of the Act, during which various incriminating materials were found, and it was found that the trustee and secretary were using the funds of the trust for personal benefit. Consequently, assessment proceedings were initiated by the AO for AY 2021-22. Subsequently, show cause notice was also issued by the PCIT, Principal Commissioner of Income Tax, requiring the assessee trust to explain as to why the registration granted to it should not be cancelled under Section 12AB. After considering The reply, the PCIT invoking the amended provisions of Section 12AB, subsection 4, clause 2, which was introduced by the Finance Act 2022 with effect from 1st April 2022, cancelled the registration granted to the assessee trust with effect from AY 2020-21. Agreed by this, the assessee trust filed an appeal before the ITA. Let's understand what tribunal observed and held at. In income tax matters, law to be applied, in income tax matters, law to be applied in income tax matter, law to be applied is the law in force in the assessment year unless otherwise stated or implied. What is important in here is that income tax matters, law to be applied is the law in force in the assessment year unless otherwise stated or implied. In the present case, the PCIT cancelled the registration granted under Section 12AA12 or 12AB with effect from previous year 2020-21 relevant to assessment year 2021-22, and therefore the law as stated in the AY 21-22 is to be applied and not the law as stood in AY 22-23. Without a specific mention of the amended provisions to operate retrospectively, no cancellation for the earlier years could be made. Since PCIT invoked Section 12AB, subsection 4, clause 2, which has been introduced by the Finance Act 2022 with effect from 1st April 2022, so as to cancel the registration with retrospective effect from AY 21-22, such order is bad in law and deserve to be quashed. Appeal of the assessee trust was allowed. Next, Messrs. Arif and Company versus ACIT ITA number 140 Chennai 2022 and relevant assessment year is assessment year 2007-8. Date of order is 15th December 2023 and relevant section is section 36 subsection 1 clause 3. Let's understand facts and issue of the case. Assessee firm had family members as its partners, had borrowed a loan from the bank to settle the outgoing partner's capital account, and paid interest with respect to borrowed funds. Raised fresh capital from the incoming partner and paid interest thereon. The AO disallowed the interest paid by the assessee firm to the capital account of partners and also on loan borrowed from the bank on the ground that payment to outgoing partners was nothing but a family settlement. The disallowance was upheld by the CIT appeals. Aggrieved, the assessee filed an appeal before the tribunal. Let's see what tribunal observed and held. Interest paid on capital account of partners partakes the nature of funds borrowed for the purpose of business of the assessee, and consequently interest paid thereon is allowable under section 36 subsection 1 clause 3. And any loan borrowed for the purpose of settling outgoing partner's capital account which has been treated as a debt in the books of accounts of the firm assumes the character of loan borrowed for the purpose of business of the assessee, and consequently interest paid on borrowed capital account is allowable under section 36 subsection 1 clause 3. Just because the partners were family members, it cannot be considered as settlement of family property. The appeal filed by the assessee was allowed. One case I have choose here is ITAT International Tax. Let's see what is the case. Lex Portal Vision Private Limited versus Income Tax Officer 2024, ITN number 2397, Delhi 2023, and relevant assessment year is assessment year 1819. Date of order is 26th December 2023. Relevant section is section 9, section 195, and section 201 of the IT Act. Let's understand facts and issue of the case. Assisi was engaged in the business of broadcasting or sub-licensing a right to broadcast sports events. The Assisi filed a return of income relevant year declaring nil total income. During the year, SSC had entered into agreements with certain non-residents for acquiring the two types of rights. Two types of rights. One, right to broadcast live sports events, that is called as live rights, and right to use audio-visual recording of the sports events as non-live rights. The assessee treated payments with respect to non-live rights as royalty in terms of Section 9, subsection 1, clause 6 of the Act and deducted tax thereon. However, the assessee didn't deduct tax under Section 195 on payments made for live rights. In appeals, CIT appeals held the payment for live rights was chargeable to tax as a royalty. Let's understand what tribunal observed and held here. Based on the examination as per Section 9, read with Section 195 and 201 of the Act, broadcasting live events doesn't amount to work in which copyright subsists, as right to broadcast live events, that is live rights, is not copyright. Therefore, any payment made towards live rights cannot be said to be chargeable to tax as royalty under Section 9, subsection 1, clause 6 of the Act. Now let's move on to the High Court cases. First, Srimati Kuni Sahu versus Union of India 2023 457 ITR 777 Gujarat High Court, date of order 30th January 2023, and relevant section is section 194 subsection 3. Let's understand the issue of the case. Issue under consideration was that whether tax is required to be deducted from the payment of interest on compensation awarded by motor accidents claims, even if it doesn't exceed rupees 50,000 in a financial year. This was the issue. Let's understand what Gujarat High Court observed and held at. Interest payable under consideration was relatable to the period under the case is related to the period 2013-14 to 2019-20. If the interest were spread over year to year, the amount would not exceed rupees 50,000 and therefore no deduction at source was required. Next, Nitin Nema versus Principal CCIT 2023 458 ITR 690 Madhya Pradesh High Court, and relevant assessment year is assessment year 2016-17, date of order 16th August 2023, and relevant section is section 147, 148, 148A clause B and 148A clause D. Let's understand issue of the case. Issue under consideration was that whether gross sale consideration is the income chargeable to tax, and the distinction between the word income and income chargeable to tax. Let's see what Madhya Pradesh High Court observed and held. The expression income is inclusively defined under section 2 subsection 24, whereas income chargeable to tax denotes an amount which is less than the income. The income chargeable to tax is arrived at after deducting from income the permissible deductions under the Act, and therefore the quantum of income is invariably more than income chargeable to tax. The department in given case failed to understand the fundamental difference between sale consideration and income chargeable to tax. Consequently, this petition stands allowed in the favor of the assessor. Next, Grassing Industries Limited versus ACIT 2023 458 ITR 1, Bombay High Court, relevant assessment year 1990-91 and 1991-92. Date of order 1st September 2023, and relevant section are section 92 CA, 144 C and 153. Let's understand issue of the case. Issue under consideration was that whether amount wrongly deducted as tax to be refunded if the person receiving payment not claimed credit therefor. Let's see what Bombay High Court observed and held. The amount wrongly deducted or paid to the revenue authorities where it was not required to be paid would become refundable to the assessee. And this is subject to the condition that the person receiving the payment had not claimed the credit therefor. This is for the today's part 3. Hope you like this video and understand the case laws also. If you want, if you want this PPT, text me or comment under the video, means below the video, you can comment me your email ID so that I can share with you the PPT of this part 3. So remain updated by the whatever profession you need, as per your requirement, and hope I serve for you by this video. Thank you. Thank you so much for patient hearing. See you soon in next video. Thank you. Thank you so much.